what we're going to be going over here is how we'd use cost, volume, profit analysis in decision making. So for our example, this is what we're going to be looking at. We're going to have to make a decision here on increasing our advertising dollars on a certain product. Currently, we're selling this product. We have a certain number of units that we're selling on the product, and we're generating a certain operating income based on those units sold. And what we want to do is we want to sell more units here, and by doing so, we want to increase our operating income. And what we're going to be looking at here is spending an extra $1,000 here in advertising dollars, and based on that extra $1,000 we're spending in advertising, we're estimating that we're going to have increased our sales on this product by 10%. So the question is this a good investment here by spending the extra $1,000 and to generate the extra 10% here in sales? So when we're looking at this in terms of cost, volume, profit analysis, these advertising dollars here, they are really a fixed cost. So if you sell one unit or hundreds of units, you still have the fixed cost here of $1,000. So what we want to do here when we're looking at these problems and decision making, we really want to look at what we're currently doing here versus our proposal. And again, for our analysis here, and we're going to be looking at a cost, volume, profit graph, and we're going to lay out our decision making in those terms. So what you want to do here when you're talking about cost, volume, profit, really you're going to be looking at your units sold, and I'm showing that on our x-axis here from 0 to 300, and then on our y-axis here, this is where we're looking at our operating income. And the point is here, when you sell more units, you should have a greater operating income. Okay, so let's go back to our analysis here. So what you want to do, again, look at a side-by-side comparison between what you're currently doing here and what you propose. And when we're looking at this analysis here, we're going to have these set up this profit volume line here, and that's really looking at the case here where you start out at some fixed cost, and that fixed cost has to be covered here. You have to earn a certain amount of operating income here before you reach, actually, when we talk about operating income, we're actually operating at a loss here until we hit a certain break-even point on those units sold where our operating income is actually zero. So we start out at a negative amount, that's our fixed cost, and when we move up to zero operating income here after we hit that break-even point, and then anything after that would be a positive operating income. Okay, so we're going to look at how we set up our lines here. So our blue line here, I'm showing that as our current operation here, and the green line is what we propose. So for our blue line, our current operation, what do we gain here in income for operating income for every unit that we're sold here? So this is the case here where you look at your sales price minus your variable cost. And for our example, our sales price here is $50 per unit, variable cost $30. So the difference here is going to give us $20 per unit here in what they call contribution margin. So for each unit we sell, we increase we move up here along our profit line here by $20. Okay, so what we're going to do here for our currently here, we have $2,000 here in fixed cost. And what we look at for our proposal here, we're actually going to add $1,000 here in that extra advertising for that extra advertising cost as a fixed cost. So what we're going to add is to the $2,000 here that we have currently operating at, we're going to add $1,000 to it. So we're going to have $3,000 here in fixed cost here for what we propose here for the extra advertising. Okay, so let's starting out with what's currently going on here. Well, we started out with that negative operating income here of $2,000 for our fixed cost, and then we move up the line here until we hit our break-even point. And what would that be here? Covering the $2,000 in cost and that $20 per unit. So divided $20 per unit into the 2,000, you're going to come up with a break-even point here of 100 units. So you got to sell at least 100 units here before at that point you have zero operating income, so that's the break-even point. Now for what's currently going on here, we move up to the point here where we sell 170 units here currently, 170 units here, and that matches up to our profit line right here, and that move that over here, looking at our operating income here, looking at it in terms of our graph here, that's $1,400 here in operating income. So how did we get to that point? Well, we just took the 170 units here that we sold times our contribution margin of $20 per unit. What did that give us? $3,400. But because we had to cover our $2,000 in fixed costs before we get to any operating income here, we have to look at the fact that we got the total $3,400 here that we receive less the $2,000 here in fixed cost gives us an operating income. The difference here would be operating income here, $1,400. Okay, so that's what's currently going on here. Now we have to go and we have to look at our proposal here. So remember, this is where we have to add an extra $1,000 here to the fixed cost. We're sitting here at $2,000 currently, but because we're going to spend the extra $1,000 in advertising, our fixed cost now becomes $3,000. So looking at our proposal here, we're our profit volume line here. Now this is the case we move up to, well, where would our operating income here be at zero? We have to cover that $3,000 in fixed cost, and that's actually going to be what, 150 units here. So that's simply taking the $3,000 in fixed cost divided by contribution margin per unit of $20. That's going to give us 150 units here for a break-even point. Now we're going to move up to the point where we were talking about that 10% increase in our sales here. So we'd be going from our current sales here of 170 units up to a 10% increase gives us 187 units here that we'd be selling based on our sales, our estimated sales increase of 10%. So just moving that over to our operating income line, we're going to come up with $740 here in operating income. Okay, so how do we get to the 740 here? Well, that's simply taking 187 units here times that $20 per unit contribution margin. That's going to give us what? $3,740. But because we started out here with a $3,000 here in fixed cost, we have to cover that fixed cost here before we reach any positive operating income amount. So taking your total $3,740 here dollars based on our units sold and contribution margin, we have to subtract out the $3,000 here in fixed costs, so that gives us $740 here in operating income. Okay, so now we can make our comparison here between what's currently going on here and what our proposal is here based on that 10% sales increase. So you can see here, it makes absolutely no sense to spend that extra $1,000 here in advertising cost to generate a 10% increase in sales, because you can see here our operating income here for our proposal based on that 10% sales is only $740 versus $1,400 here what we're currently doing. So we would actually be reducing our operating income here by 1/2 or 50% approximately by spending that extra $1,000 here in advertising cost. Now so that right there, we've made our decision. It's not something you want to do by spending that extra $1,000 to generate 10% sales. But just looking at it from a break-even point here, looking at our profit line here for our proposal, we'd have to move all the way up here to, well, what a 29% sales increase, and that would be 220 units here. So if you take 220 units times $20 per unit here, you're going to get what? $4,400 here, but you'd have to subtract out that $3,000 fixed cost, so you'd come up with $1,400 here. Now that's based on the fact here that we spent that extra $1,000 here in advertising cost, or we increased our fixed cost here by $1,000. So just to show here that you'd actually have to increase your sales by 29% just to equal what we're currently doing. But really, when you're looking at a decision like this, you wouldn't want to spend any dollars unless you are going to increase your operating income beyond or in above that $1,400 mark here, since $1,400 dollars here in operating income is currently what we're generating here. That's the point we want to make. Just using this cost volume profit graph, you can just trace it out. Doing some arithmetic, you can figure out where you're going here. And in this case, you can see we definitely didn't want to spend the whole $1,000 here, because it's actually reducing our operating income by spending that extra $1,000, because if you look at it, it attached we increased our fixed cost here, and we had to recover that fixed cost here before we could generate any income here. So all we did really with this fixed cost is we just shifted this line across here. We have to generate more sales based with the proposal here by spending that extra $1,000, and by doing so we have to just generate more sales here, and by doing so we actually, to make any sense of it, you have to generate, in this case, more than 220 units here based on that $1,000 extra advertising. And that's really looking at a 29% sales increase. So unless you can increase your sales to 30, 40, 50%, it's not going to make any sense based on that, on the fixed cost here of $1,000. Okay, so now let's just go down and we'll look at how we would look at these numbers here and how we'd calculate them using our equations. Okay, so now let's look at just without an increase here in our fixed cost for advertising dollars, just looking at 170 units sold and that $1,400 operating income. Currently what we're doing. So this is the case where you're going to look at that operating income equation. That's simply taking your selling price minus your variable cost times that difference times the quantity sold, taking that quantity less your fixed cost. You have to subtract out your fixed cost. That's going to give you your operating income. And currently we're looking at $1,400. Now remember, the selling price minus your variable cost, that is the contribution margin per unit. So in this case we had that selling price 50, variable cost here 30. That's a $20 contribution margin times the 170 units that we're currently selling. Then we have to subtract out that fixed cost that we currently have of $2,000. That amount equals to $1,400 here in operating income. Okay, now let's go up here and let's go through the numbers here where we'd have that increase here in that $1,000 advertising as a fixed cost. Now, same equation that we used here for that we just went over here for determining our operating income. The only point I want to make here is when you're laying out these problems and doing these problems, you can just use simple algebra here to determine any of your quantities or costs or what have you, or numbers here when you're trying to determine what those numbers might be here. So when I'm talking about simple algebra, if one of these numbers is not knowing dollars or quantities, you can stick it in just using simple algebra here. You can put it into your formula knowing the other variable amounts, and you can determine the unknown. So just looking at what you do here algebraically here, let's just say A would be our selling price less B here, our variable cost, and that amount here times C, the quantity, and you could whatever that quantity is, then you'd subtract out D, the fixed cost. That will equal E, the operating income. So just you can use simple algebra here to determine your quantities and costs, providing you know one of them is unknown and the other are known. And going back to our example here, so same equation here. Again, we had that contribution margin per unit. In this case, we're looking here at the targeted income. We're really looking at that operating income to be greater than $1,400. And for our numbers here, let's just look at, say, for that 10% increase in our sales, that was at 170 units here currently that we're selling, times 100 or 1.10 here, 1.10 here, or 10%. That's going to give us a 10% increase in our sales is 187 units. Okay, so now for our operating income that we had here, we take that was a 50 minus 30 here, a $20 contribution margin per unit times that 10% increase in our sales of 187 units here, that quantity minus the fixed cost here of $3,000. We had the $2,000, we added the extra $1,000 here in sales, so now our fixed cost is $3,000. So subtracting our number here, our $20 in contribution times 187 here units, that amount less the $3,000 in fixed cost is going to give us that operating income here of $740. Now, remember, we wanted our target greater than what we're currently operating here at $1,400, but the 740 is less than that amount by about half. It's really less than about half. So we definitely don't want to spend that extra $1,000 here in fixed cost to generate only the 10% increase in sales. Okay, so now let's look at how we'd cover our extra fixed cost, the $1,000 here, where we get the total fixed cost here of $3,000. And this is the case where we looked at the sales that our required sales would have to be greater than 29% increase in our sales for our operating income to be greater than what we're currently operating at, $1,400 here. So 29% increase in sales, that would simply be the 170 units that we're currently selling times 1.29. That equals to 220 units. Okay, so that's simple arithmetic here. But if you're doing it here when you're talking about cost volume analysis, you're going to be using on the contribution margin per unit and to determine well, let's look at that. So here, this is how we do it. Rather than doing just our arithmetic here that we knew here, if we didn't have that number or that percentage here, we would just take our quantity sold here is equal to, in this case, our fixed cost plus our operating income, and that amount divided by the contribution margin per unit. So in this case, our fixed cost was $3,000 here. Operating income, we really want more than $1,400 here, but let's just say that or to equal what we're currently doing, we have the $1,400 here in operating income. That total amount divided by the contribution margin per unit, the $20 here. So we have the fixed cost of $3,000 here plus our operating income of $1,400 divided by our contribution per unit at $20 per unit. That equals the quantity here of 220. Okay, so that's how we come up with our 220 units here based on our cost volume profit formula here on a contribution margin per unit. Okay, so that's those numbers. Now let's look at the question here. What extra advertising dollars here in fixed costs is required with our expected sales here in 10? If we only expect the sales here to be 10%, what really do we justify here in extra advertising fixed cost? And that's the case here where you'd be continuing to earn the $1,400 in operating income. Actually, you want to earn more, but we'll just look at it based on the comparison between what we're currently doing here. So what can we really justify here with extra 10% here in sales in extra fixed cost here for advertising? So again, we really need to earn more than the $1,400 operating income before we do anything if we're going to increase any of our costs here. But we'll just look at it as a break-even point. So again, this is the case where we use simple algebra. You take your sales price here minus your variable cost. Sales price is $50 per unit, variable cost here $30 here per unit times the quantity here. That quantity, remember, we calculated with the 10% increase here in our sales to be 187 units. Now, whatever quantity we have here, then we would subtract out our fixed cost. So this is what we're trying to determine our fixed cost. We'll come up with the total fixed cost here, but we'll be able to break that down between what we currently have here and any extra advertising costs. So whatever quantity we have here, subtract out our fixed cost, that's going to equal our operating income. Let's just say it's that $1,400 here. So a negative X here, fixed cost, is going to equal the $1,400 here in operating income minus whatever we had here. What was the difference here? We had a positive amount here on this side of the equation with the our contribution margin times our quantity here. That was $3,740 here, but move it over to this side of the equation, we're going to be subtracting that here from our operating income. But anyway, just divide everything here by 1. You're going to come up with your fixed cost, your total fixed cost, to be $2,340. Simply subtracting here your $1,400 here in operating income less whatever your total contribution margin is here, $3,740. So here our total fixed cost is $2,340. Now we have to subtract out what our current fixed cost amount would be here. That was that $2,000. So here the difference is going to give us their extra advertising that we can actually spend here. We expend just to equate our current operating income with that extra advertising cost is only $340 here. Yeah, that's just using just a point here to use simple algebra to determine what extra advertising that is really justified here based on that current operating income here of $1,400. So figure out whatever, just going through your simple equation here, figure out what, in this case we have to figure out our total fixed cost here based on that extra sales increase here of 187, our extra sales generated at 10% extra sales quantity that we generated here of 187. So those are really our changes here from what we had with our current operations versus our proposal. So just simple arithmetic here, determine what your fixed cost would be here based on that extra quantity that we saw, or extra sales increased here, and then you'd have to subtract whatever your current fixed cost was. In this case it was $2,000. Subtracting that here from the $2,340 gave us our extra advertising cost here of $340 based on that 10% sales increase. Okay, so that's basically what you're going to go through here when you're looking at this this cost volume profit analysis. Decision making, and really we just looked at how our decision here had been based on a change in really our fixed cost.